This week, Blackrock put out an update to their model portfolios for financial advisor use. This is the first update since the end of February, and unless you've been out camping or you just do not pay attention to the news, we all know that the market has gone through a wild ride since the end of February. This is a chart of the S&P 500 ETF SPY, and February 19th, it was at its high. It went basically straight down and then almost straight back up. And so currently, we're not quite back to the high, but we've recovered most of the losses that happened in March and April. The model portfolios that I'm going to talk about from BlackRock are put out for financial advisor use. And if you have your assets managed by a financial advisor, they might actually be using these model portfolios. When we take a look at the specific changes to the ETFs that are being held, you'll be able to see when you look at your statement if your advisor has changed things for you to match these model portfolios. This is a spreadsheet of the different changes that they recommend by specific funds. And the big change is the first one on the list here, an 8% decrease in the iShares Core S&P 500 ETF. Now, that's a big change, 8%. So what are they recommending money goes into instead of this Core S&P 500 ETF? The big one is a 3% increase in this iShares US Thematic Rotation Active ETF. When I was at a conference in Las Vegas a couple months ago, all of the ETF companies were promoting active ETFs. Active ETFs are more like what mutual funds used to be in the old days, where they try and pick winning stocks and try and beat the stock market. BlackRock owns iShares ETFs, so regardless, BlackRock will be making money off of these allocations. But when we look a little bit closer, there's maybe a motivation for making money in here. The iShares US Thematic Rotation Active ETF, THRO, has an adjusted expense ratio of 0.6% per year, whereas the basic index fund, IVV, has an expense ratio of 0.03% per year. So this new fund that they're recommending is more expensive to the client, and therefore it's going to be a bigger moneymaker for BlackRock. But some things are worth paying for, right? So let's take a look at the returns and see how they compare. To compare the returns of these funds, I'm using portfoliovisualizer.com, and I've loaded in here IVV, THRO, and then another ETF that adjusts its holdings based on certain signals. Its ticker symbol is OMFL, and I've made videos about it in the past. And then when you click on Analyze Portfolios down here, the returns are shown. THRO is a fairly new ETF. It's only been around for 3 years. And when we scroll down, we see the actual returns for those 3 years, starting with a $10,000 balance. THRO, the second line here, has outperformed the other two funds, and it has outperformed the standard S&P 500 index fund by more than 1.5% per year. So even though it costs 0.5% more, it has had better returns. So in this case, it is worth paying for if it continues to have good returns. Obviously, we won't know that. That's the risk of investing, but it looks like it could be a good idea. If we look at the other changes BlackRock recommends, they say increase the holdings in the S&P 100 ETF. This means the 100 largest companies. And then they also like the AI innovation and tech theme. So that's another ETF from iShares. BAI is the ticker symbol. They are recommending a big increase of 3% in the International Value ETF, EFV. Previously in February, they were equal weight between growth and value internationally. Now they're saying increased value. These two changes, they now prefer Chinese stocks. So they say sell out of the emerging markets ex-China and just get into the regular emerging markets ETF. For the bond market changes, there's a small change of moving out of the broad-based total US dollar bond market ETF, IUSB, and into the iShares 10 to 20 year Treasury bond ETF, symbol TLH. The big change to the bond portfolio is a 3% increase to the International Aggregate Bond ETF. And the reason for this is that emerging market bonds have done well in the past in times of easing monetary policy and falling inflation. Also, they have a relatively high yield. So BlackRock recommends you increase your allocation to those types of funds, specifically IAGG. So that's it for the current May update on the BlackRock model portfolios. If you do want to learn more, you should check out blackrock.com. They do have a lot of free information about investing and their thoughts and ideas. It might really be worth your while to check it out. That's all for now. See you next time.